$1. That's what you start with. $1 put somewhere it can grow. And if you don't touch it, if you just let it sit in the right place, something strange starts to happen. Albert Einstein, and yeah, the attribution is debated, but the point stands, reportedly called compound interest the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. And honestly, most people have heard the term. They nod when someone mentions it, but almost nobody actually understands what makes it so powerful. Because compound interest doesn't just grow your money, it changes the math of your entire life. And by the end of this video, you'll understand exactly how the machine works, how it might be working against you right now, and the exact steps to flip it in your favor, whether you're 25 or 55. Because here's a truth we'll get to later. Your age matters, but your next decision matters more. Let me show you something that'll make this click immediately. Two people, Alex and Jordan, both 25 years old, both earning the same income, same city, same expenses, same starting point. Watch what happens. Alex starts investing $200 a month at age 25, does it for 10 years, then stops completely. Never puts in another dollar after 35. Total invested out of pocket, $24,000. Jordan waits, doesn't start until age 35, but then invests $200 a month for 30 years straight. Never misses a month. Total invested, $72,000, 3 times what Alex put in. So who has more money at 65? Alex, by over $100,000. Despite investing $48,000 less. Let that break your brain for a second. Alex put in less money. Alex stopped investing 30 years early, and Alex still wins, by 6 figures. That's not a math trick, that's compound interest. And the only variable that made the difference was time, not skill. Not luck, not a hot stock pick. Just time. This is the code kings understood before Wall Street gave it a formula. Wealth isn't built by one big pile of gold. It's built by systems that keep producing after you stop touching them. Mansa Musa knew this 700 years ago. Alex just proved it with $200 a month. Time is the only currency even I couldn't buy more of. And that story proves why it's the most expensive one, which means the most important financial decision you'll ever make isn't what to invest in. It's when you start. And if you've already started, you're ahead of almost everyone reading this. If you haven't, today is the youngest you'll ever be again. That's not pressure, that's opportunity. But before I show you the exact steps, you need to understand how the machine actually works. Because once you see the mechanics, you'll never look at a dollar the same way. And you'll understand why what I'm about to show you in the dark side section might be the most important 2 minutes in this entire video. Okay, so let's break this down to the mechanics. Simple interest means you earn interest only on your original amount. You put in $1,000 at 10%, you get $100 a year every year. Same 100. That's it. Compound interest means you earn interest on your interest. Year 1, you earn $100 on your 1,000. But year 2, you earn 10% on 1,100. That's 110. Year 3, 10% on 1,210. That's 121. The difference seems tiny at first. A few extra dollars. Who cares? Here's where it gets dangerous. In a good way. If you plot simple interest on a chart, it's a straight line going up slowly, predictable, flat, boring. But compound interest, it's a curve, nearly flat at first, almost identical to the straight line. Somewhere around year 10 to 15, the curve starts bending. By year 20, it's pulling away. By year 30, it's vertical. It's not even on the same chart anymore. And this is why most people miss it. They quit during the flat part. They look at their account after 2 years and think this isn't working. They expected a rocket and got a bicycle. But they were standing at the base of a rocket that hadn't left the launch pad yet. The bicycle was the rocket. It just needed time to ignite. And the people who got off the bicycle, they'll never know what would have happened if they'd stayed on. Mansa Musa understood this 700 years before anyone drew a compound interest chart. His first trade route between the gold mines and the salt markets? Small, barely profitable, a bicycle. But he didn't shut it down. He let it run. And as it generated revenue, he reinvested that revenue into a second route, then a third. Each route funded the next one. Each one compounded on the last. By the time European cartographers drew his face on their maps, those routes had been compounding for decades. The bicycle had become an empire. Same math, different century. But here's the part that actually terrified me when I ran the numbers. Because compound interest doesn't just work for you, it also works against you. And most people are on the wrong side right now without even knowing it. This might be the most important 2 minutes you watch today. Credit card debt. at roughly 24% interest, which is where many cards sit right now. That debt compounds against you. If you put $5,000 on a credit card at 24% and make minimum payments, you won't pay it off for over 15 years, and you'll pay nearly $8,000 in interest, more than the original purchase. The ghost of that purchase ends up costing more than the thing itself. And here's the part that should make you angry, not sad, angry. Minimum payments are designed to maximize this effect. The credit card company calculated the exact amount you need to pay to stay in debt for the maximum number of years while paying the maximum interest. That minimum payment isn't a kindness. It's a strategy. Their strategy. Against you. The exact same mathematical force that could make you a millionaire is the one that keeps people trapped in debt. It's the same curve, same formula, same compounding engine. It just depends which side you're on. And right now you're on one side or the other. There's no neutral. Your money is either compounding for you or against you. Every single day. Here's the contrarian truth about this. If you have credit card debt, paying it off is the best investment you can make. Better than stocks, better than real estate, better than crypto. You can't earn 24% guaranteed anywhere in the market. But paying off a 24% credit card, that is a 24% guaranteed return. No risk, no volatility, just pure math in your favor. Start there. That one move flips you from the wrong side of the curve to the right side overnight. If you have no debt but your money is sitting in a savings account earning nothing, you're not on the bad side, but you're not on the good side either. You're in neutral. And here's another contrarian truth. Neutral is just slow motion losing because inflation is compounding against your purchasing power every single day. Your savings account earns 0.01%. Inflation runs at 4%. Your money is evaporating and the jar looks full. Okay, so now you understand both sides of the curve. But here's the part that most finance videos skip entirely, and it's the question I know some of you are already asking. What if you're not 25? What if you're 35, 40, 45? Did you miss the window? Here's the truth. Compound interest is more powerful the earlier you start. That's just math. But the second best time to start is right now today, not next month, not after your raise, not after the debt is paid off, now. And here's what should calm you down if you're over 35. Your age matters, it does, but your next decision matters more. Most wealth is built after 40 anyway. The compound curve's biggest moves happen in the last third of the timeline. The people who started at 25? Most of their growth happens after 45 too. You're closer to the vertical part than you think at 25. Investing $200 a month at a historically typical return of around 10%, roughly what the S&P 500 has averaged over long periods, though past returns don't guarantee future results. You end up with approximately $1.2 million by 65. You put in $96,000. Compound interest generated over $1.1 million. The math did 90% of the work. Start at 35, same contribution, same return. You end with about $450,000. Still incredible. Still life-changing. The 10-year delay cost you $750,000. Not because you did anything wrong, just because the curve had less time to bend. Start at 45? You end with about $150,000. Still far better than nothing. Still more than most Americans have at retirement. But here's the net gain in all of this, and this is the part I need you to hear. Every single one of those curves goes up. Every single one ends dramatically higher than where it started. The 25-year-old's curve is the tallest, but all three curves are climbing. All three end in a place that's infinitely better than doing nothing. The worst version of compound interest working for you is still infinitely better than compound interest working against you or not working at all. So wherever you are right now, that's your starting point. Not your limitation. Not your punishment for not starting earlier. Your starting point. And every single day from this point forward, the curve is bending in your favor. That's not motivation. That's math. Now here's the part that puts it all together, the actual steps. Because understanding compound interest means nothing if you don't activate it. Step 1. If you have credit card debt, that's your first move. Pay it off aggressively. Every extra dollar above the minimum goes to the highest interest balance first. You're not saving yet. You're stopping the bleeding. You're getting off the wrong side of the curve. Step 2. Once the high interest debt is gone, build a 1-month emergency buffer, then 2 months, then 3. This goes in a high-yield savings account, not investing, just protecting. This prevents you from ever falling back to the wrong side of the curve. Step 3. Open a brokerage account. Set up automatic monthly contributions into a broad index fund, the S&P 500, or a total stock market fund. Start with whatever you can. $50, $100, $200. The amount matters less than the automation. You need the system running without requiring your willpower every month. Step 4. Don't touch it. This is the hardest step and the most important. Don't check it daily. Don't panic when the market dips. Don't pull it out when the news is scary. The curve needs time. Every time you interrupt it, you reset the clock on the most powerful section, the vertical part at the end. That's it. 4 steps. Stop the bleed. Build the shield. Start the machine. Don't touch it. The system is simple. The math does the hard part. Your only job is to start and then not stop. Mansa Musa didn't stand at every gold mine personally swinging a pickaxe. He didn't monitor every trade caravan. He built the system, set it in motion, and let compounding do what compounding does. Decades later, the system had generated more wealth than any individual could have created through effort alone. Your index fund is your trade route. Your monthly contribution is your caravan of gold. And time? Time is the Sahara, vast, patient, and undefeated. Here's what's real. The difference between wealth and scarcity isn't intelligence. It isn't luck. It isn't even income. It's the decision to put $1 somewhere it can grow and then leave it there long enough for the math to take over. $1. That's how every fortune starts. Even mine. The first gold nugget pulled from a Mali mine didn't look like $400 billion. It looked like a rock. But it was the first unit in a compounding system that would outlast centuries. Your first dollar into an index fund doesn't look like $1 million. It looks like nothing. It looks like a rock. But it's the most powerful financial decision you'll ever make, because that $1, given enough time, bends the curve. And once the curve bends, it never straightens back. You don't need 80 camels. You need $1 and time. The eighth wonder of the world isn't magic, it's patience.